Gonna try not to bore you all, but this might be a little longer than my usual video. So what is the point of investing? What's the point of investing? The point of investing is to have access to more money than what your salary pays you, right? I think that's everybody's goal. And if you're like me, you're tired of hearing all the noise in the market centered around what's going on and what's going to happen next year and all the panic being spread. Every other video is about how the Fed is talking about job loss and an economic recession and how it's expected to hit us like Thor's hammer, right? There's just a ton of fear-mongering being spread out there. And honestly, if I were to assume that all these things are true, or if we were to assume that all these things are true, my question is, what can you honestly do about it? What can you really do with this information? You gonna go quit your job so they can't fire you or lay you off? No, that's not practical. They talk about the car bubble popping. Okay, cool. So what are you gonna go buy 3 new used cars next week? No, that's not practical. With the knowledge of the market potentially bottoming next year, are you going to go and sell off all of your investments to avoid taking any losses in the market?
God, I hope not.
What I'm saying is that regardless of what is happening, life will go on, and so will the stock market. And aside from maybe boosting the amount of money you save every week versus how much you invest, I don't really see any major changes that we can make right now in our day-to-day lives to prepare for a potential job loss or downturn in the market, aside from sending out resumes and maybe looking for a backup job and saving more money than we usually do. Now, if you're playing around with options or jumping in and out of trades, I can understand how that type of information could be a bit more useful to you. But if you're a long-term investor, buying companies to hold for years and decades, then this information is cool, but at the end of the day, it doesn't really change your strategy all that much, right? But there are minor adjustments I think we can make depending on your very own circumstances. So instead of buying into the fear, I'm doing 3 different things, okay, to be sort of proactive against the noise. Number 1, I already have a Cash App Sunday, sometimes Monday series going, which I'm behind on. But there's a reason for that. I'll tell you more on that later. Where I invest a little bit of money every week into my Cash App portfolio. And this is designed to be a hedge against inflation and any possible recession, okay? Recession proof, if you will. So that's number 1. Number 2, I've changed my current investing strategy where I dollar cost average daily into the market. And I've done this in favor of keeping more cash on hand for a number of reasons. If the job market is going to get crazy next year, especially in my industry of where I work, I can totally see that happening. Then I'd like to have more cash on hand, more cash saved up in case I need some extra help financially if I were to lose my job. Also, stacking cash right now puts me in a position later to be able to react in the event that the market does get pile drived into oblivion. If the market takes a major hit and stocks start reaching new lows, I'll be right where I need to be financially to capitalize on those bargain sales. So while I'm still investing into my Cash App Challenge daily, all of my other daily investments are currently on hold. And number 3, I thought it would be cool to start up another passive income stream by creating a dividend-only focused portfolio. Yes, I'm aware this sounds contradictory to what I just said about being cash heavy, but just hear me out. I'm only going to be investing small amounts into this dividend portfolio starting out. So what I invest on a weekly or daily basis may vary. And because I have investments in 5 different brokerages already, I was looking for something to start fresh with and settled on the Public Investing app. Reason being, its interface seems simple enough and they offer partial shares, which is very important these days and especially very important to me for someone who wants to dollar cost average into things. And the only money I've had in there is about 20 bucks that I placed in some crypto maybe about a year ago. So I thought I'd sell that and start from zero. All of the dividend payments I'm receiving now are mixed in with my long-term value investments, so everything feels sort of like jumbled. So I wanted to have a dividend-only focused portfolio that I could build out over time, separate from everything else, and see just how much I could grow this to provide that passive income that we should all love. So today, I'm going to be picking out a dividend-focused stock that I'm going to start with, and hopefully over time, this portfolio compounds and develops into a great passive income journey. And even more important, hopefully in times of economic uncertainty, this portfolio will be something I can turn to help offset any financial obligations I may struggle to fulfill. So I'll be giving regular updates on this to analyze my investments and make adjustments as needed, as well as share with you all what I'm adding or potentially selling off. As I said, I don't have a set amount of how much I'm going to be investing right now, but I may end up setting a weekly target in the future. But right now, it's going to be whatever I can afford to contribute at whatever time. All right, so starting this thing off, the first stock I'm going to purchase for this dividend portfolio is SCHD, Charles Schwab U.S. Dividend Equity ETF, which means, yes, the brokerage Charles Schwab owns this ETF. This is a stock that seems to be extremely popular lately, but contrary to what you may be thinking, this is not why I'm selecting this position to start with. So let's talk about it. So SCHD is an ETF, right? ETF, which stands for Exchange Traded Fund, which means it's a stock that has within it several holdings of other companies and businesses. And before I go over some of the top holdings, I wanted to explain what this ETF is all about. What sets this ETF apart from others is that it's focused on dividend-paying companies and has specific guidelines for those companies in order to meet the requirements to be in this fund. This ETF will automatically remove any company that has not paid dividends for 10 consecutive years. That tells you right there that one of the goals of this ETF is to make sure that we are invested in dividend secured positions. This ETF also ranks stocks that meet those criteria by annual dividend yield and screens out those that rank in the bottom half. So in other words, that dividend yield has to be a certain percentage in order to stay on the list, which means that companies who are increasing their dividends are the ones that are likely to be included. This also means that this is an ETF that has to be actively managed, right? Someone has to go through and filter out what company stays and which ones get banished to the shadow realm. And ain't nobody gonna do that for free, which means there's a cost associated with actively managed ETFs like this one. And right now, there's an expense ratio on this. Somebody tell Mo from Everything Money that this is what expense ratio means. Expense ratio is how much you and I are paying to own shares in this actively managed ETF. And right now, that cost is 0.06%, which is very, very low, okay? But for a general idea of how much you're paying, let's put numbers to it. So for every $1,000 you invest into this ETF, you'll be paying 60 cents. Again, that's super low, barely noticeable. You can't get anything for 60 cents these days. And these get taken out directly from your investment, all right? So another requirement is market cap. This ETF will not include companies with a market cap under 500 million. They want proven companies and brands with a wide moat, which is one of the things Warren Buffett talks about. These parameters are also placed to keep the risk of their invested companies at a minimum. All right, so we want to know what's in this thing. What are the companies we're investing in when we buy into SCHD? I want to note here that this is another difference between this ETF and some of the others out there that are well known. This ETF only has about 100 companies within it. So this is a far cry from something like VTI or VOO that have hundreds to thousands of stocks inside of their collection. And so for that reason, some people might consider this ETF to be a lot less diversified than others. But again, it's all about being selective with the ETF. So there's a little give and a little take, right? A little less diversification for a more focused return through higher dividend paying companies. Okay, so what are those companies? I'm not going to go over all 100 companies, but I will go over the top 10 holdings that each make up about 4% of their holdings to start with, all right? So number one, Merck. Now, I had to go and look this up. I had no idea what Merck was, all right? So I had to go do my research. And what I found is that Merck is a pharmaceutical giant. In fact, they're number 7 on the top 10 pharmaceutical companies in the world list with a total revenue of $42 billion, okay? So some of their most notable products include vaccines, prescription medicines, and brands like Clarinex and the NuvaRing, which is like this small little soft plastic ring that a woman takes and like Number 2, Amgen. This is a leading company that specializes in biotechnology. Number 3, IBM. Number 4, Broadcom. Number 5, Pepsi. Number 6, BlackRock. Yes, the same BlackRock that invested in FTX. Number 7, Lockheed Martin Corporation. Yes, the same Lockheed Martin that just lost millions of dollars from a tweet. Wait, am I sure I want to invest in this still? Number 8, Verizon. And number 9, Cisco. No, not that Cisco. Cisco Systems. And number 10, Pfizer. So as you can see, these aren't small corporations or companies at the top of their holdings, all right? These are all experienced, battle-tested brands that have proven track records. So let's take a look at the chart and see how this has been performing against the overall market. So essentially, let's put SCHD up against VT, which for clarity, VT is the Vanguard Total World Stock Index, which means, yes, VT also includes foreign stocks. This thing has nearly 10,000 different stocks from all over the world inside of its holdings, all right? Hence the name Total World Index. So this is a far cry from the 100 holdings that we have with SCHD. But let's compare the 5-year and 1-year charts of these two to get an idea of how they've performed. And we can see it's no contest. SCHD has completely lapped VT on the 5-year chart, and when we go to the 1 year, we see that SCHD hasn't lost nearly as much as VT has. And although past performance does not always indicate future growth, it's an interesting comparison to note nonetheless. Now, the last thing I want to look at is the dividend payout. They're currently paying out a quarterly 3.3% dividend yield, which means you get 4 different checks out of the year from this ETF, I believe in March, June, September, and December. Those are the payout months. And so I think this is the perfect start to a dividend-focused portfolio. One other thing to note here is that SCHD does not have any exposure to REITs, which for a lot of dividend portfolios, REITs are a major part of their performance since they usually offer the highest dividend payout. So if I want some exposure to REITs in this portfolio, I'm going to eventually have to add something like Realty Income or maybe Main Street Capital. But listen, let me know what you all think in the comments down below. If you're making any changes to the way you're investing right now or in the future next year. In the meantime, remember to invest responsibly, and I will see you all in the next one. Later.
What's happening?